Hello students and welcome to the lecture. So students, as you can see here that basically in this lecture, we are going to start with the banking and history. Okay. This is going to be our topic to be discussed in this particular lecture. So before starting this, let me tell you one thing in a straightforward manner that the banking and its history is an important topic from the quantity exams point of view. Okay. Because banking is actually an important section when we talk about the country as a whole. Okay, in economy, the banking is like a backbone of the country in various aspects, and the banking is not that much newly inducted in the country or in the modernized world, which means basically the banking existed even in the ancient times, got further modified during the medieval times, and the current shape that this have, it is actually developed somewhere around the modern times. So with the passage of time, the banking also evolved from raw form to some mature form, intermediate form, you could also call it. And then the final form is still the final form. They are evolving. Okay. So that is what we call as a banking. And that's why it is important that we must learn about the banking and we must take an overview of its history. Got it? So basically in this lecture, we will talk about it and we will start by this. Banking and its history. Introduction. Market size. History of banking sector in India. Different stages of development of Indian banking. Regional rural banks. New private sector banks. Major controls schemes introduced in banking sector from 1968 year reform introduced. And then at last we will have a discussion over the summary of all the topics that we will cover. So this is going to be our path of action in this particular lecture. Got it? But before this, as we know, there is a small disclaimer presented over here. And the disclaimer is like, the images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, then please contact us at sathee@iitk.ac.in and we shall remove the images. Now let's begin. So basically, if we talk about the banking and its history, so first we have to talk about what you mean by the banking. Then what is its history? Like how does it evolve over the period of time? This is going to be the perfect way to learn about it. Okay. So broadly, if we say the banking could be defined as the activity of accepting the deposits from the general public and the entities and lending that money to earn profits. Like we know generally when we talk about the banks, then we only get two things. First, we are depositing our money with them. Second, we are taking the loan from it. Okay. This is merely a most, you can say basic thing of the bank. And how does the bank earns profit from it? How does it generate the income from it? So basically you can say when, suppose there is a person, Mr. X, and there is another person, Mr. Y. Mr. X is having some excess of money. So he went to the bank, he deposited his money on 4% interest, which means now he is entitled to receive 4% interest from the bank. Got it? On the other hand, Mr. Y is there. Mr. Y is having the shortage of money. So he went to the bank and he applied for a loan. And at loan, he received the loan at 7% interest. Now, he is liable to pay 7% interest to the bank on the loan amount that he has taken. So now you can say how much the bank has providing you? 4%. How much they were earning from the Mr. Y? 7%. 7 minus 4 is there the excess of 3%. And that 3% is actually the profit for the bank. And that's how the bank earns. And that's why whenever you deposit your money with the bank gives you interest because your bank requires that money so that the bank could lend out that money to the another person and receive the interest from as the income part. Okay. So this is the one of the most basic introduction of the banking we could have. But the question is that is banking all about this? No. Banking was all about this when it was started, but now it is far different from that. Like, but now the banking is not only including deposits and loans, but also includes providing services like insurance of debit and credit cards, providing safe custody of valuable items, lockers, ATM services, and online transfer of funds across the country or the world. Okay. Now this is all about the banking. It means merely dependent on lending and accepting. Now they are providing the various kind of services, debit and credit cards and other kind of things in the country, as well as various banks have opened their branches throughout the world. So that's why they are also called the international banks. Okay. The bank is actually a financial institution, performs the banking activity, therefore accepts deposits and lending of funds to earn profit. Like we could say, financial institution, what do you mean by this? First, it means if there is any financial institution, then it will be engaged in activity of financing, which means if there is any shortage of money and all, then that particular institution will provide the money to fulfill that particular shortage. Okay. And basically the money the bank has been providing you is the money which the bank has successfully deposited from the public. So that's why the banking activity therefore is like they accepting the deposits and they lending the they're lending the funds to the people on which they're earning profit. And the same thing now we have discussed just like 4% they are giving to the customer who has submitted his money with them, and 7% they are receiving from the customer who has taken a loan from them. So the remaining 3% is their profit. Any company which transacts a business of banking, defined above, is termed as banking company. Which means if there is any particular organization or company that is actually working in these fields, then these could be the bank. But remember, apart from this, these are the most essential things. Like if the particular organization is accepting the deposit from the people and lending out the fund, then only that could be a banking company because it is the foremost, or you can say the most basic function of bank. Any other thing the banks will have, any other things the company will have, that will not a bank. Introduction. As per the Reserve Bank of India, India's banking sector is sufficiently capitalized and well regulated. Like we know, in 1935 we established the Reserve Bank of India, and that is actually the main controller and monitor or guider of the Indian banking system, okay, or Indian banking sector. So actually under this its guidance, basically most of the banks, or we can say almost all the banks of the country works. So that's why as per the guidelines of Reserve Bank of India, the Indian banking sector is sufficiently capitalized, which means they having the sufficient capital or the deposit with them so that they could lend out the money and running their business. Even they are well regulated, which means that these are having some liability towards the people and they could not run after only the profit. Okay, that is what the system is. Indian banking industry recently witnessed the rollout of innovative banking models like payment and small banks or small finance bank. Like we can say about payment and small finance bank, we will learn about further when we have a discussion over the types of banks. Since then, we can say basically as the time modifies, okay, even the banking and banking structure undergone are different changes and new innovations. So finance banks, small finance bank and payment banks are one of the finest example of that particular innovations that have taken place on that time. Okay. The RBI's new measure may go long way in helping the restructuring of the domestic banking industry. Now we have the digital payment system. In India, it has evolved the most among 25 countries with immediate payment services being the only system at level 5 in the faster payment innovation index. Like we could say in India, further we have deployed so many systems and digital payment system is one of this. And because of this, India has evolved as a part of 25 countries. But India's payment system, immediate payment system, IMPS, it is the only system which having the level 5 in the faster payment innovation index. So that is one of the achievements of India that we have received. After the introduction, now let's move forward. Now we have to talk about the market size. Like what is the consumer base? Okay. What is the other kind of things the Indian banking sector have and all. So basically we could say public sector banks in India controls more than 70% of the banking system assets, thereby leaving a comparatively smaller share for its private peers. Banks are also encouraging their customers to manage their finances using mobile phones. So what we are getting here is that basically in India, the public sector banks or those banks which are under the control of government, these banks are having more than 70% of the banking system assets, which means consumer base, financial services, resources to avail that services and all. And if 70% is with them, thereby they leaving comparatively very smaller share for its private peers. It means the private banks only get up to the 30% of the banking system assets in India. Got it? So in India, we could say the banking is well regulated by the government, whereas the private participation is somewhat limited. Banks also encouraging their customers to manage their finances using their mobile phones. Okay, like many banks now having the mobile application or mobile app in which you can log in by providing your some banking credential or customer credential, and then you could avail almost every service of the bank by your phone. Okay, it means that you are not required to visit the branches physically. Instead of this, you could use them from wherever you want to. Then, as per the Reserve Bank of India allows more features such as unlimited fund transfer between the wallets and the bank accounts. Mobile wallets are expected to become stronger players in the financial ecosystem. So basically, you can say in your mobile, you will get an option of wallet. Okay. In wallet, you can make a number of unlimited fund transfers. Okay. And then you could use that wallet for your various financial purposes. Okay. And that's why, because of the ease of this thing, the mobile wallets expected to become the more strong players in the financial ecosystem, because they come up with the ease of making the payments and using the banking services. Now let's have a talk about the history of banking sector in India. Like how does the banking sector evolve? So let me tell you, actually the banking system was existing during the ancient times. Like during the Indus Valley civilization, we have a trust like these people are doing the import and export with the help of merchant banks and all. But that was not that kind of banking that we experiencing today. In medieval times, basically, the you can say the royal households, the rulers, they started providing the agricultural loans to the farmers so that they could use it in growing their crops and all. And as an interest, their taxable crop ratio will be increased and some more portion of crop they are required to provide to the royal household as a tax and the interest payment of that loan. But actually, the main, you can say, progress in the banking sector that has been begun with the arrival of Europeans in India. I'm not saying particularly Britishers, but with the Europeans. Okay, like what happened when the Europeans came to the country, they brought a monetary economy. Prior to this, we have the barter economy, so that's why we did not feel that we must having the banking system. Okay, but with the arrival of monetary economy, the banking system started evolving in India at a rapid rate. Because now you could not exchange your things in favor of another thing. All right. Now you require the money. And the money is actually in the control of the banks. So that's why the importance of banks evolved further. Okay. And we can say the first that we have, the first bank of joint stock variety was Bank of Bombay. Established in 1720 in Bombay. Okay. That was the first joint stock variety. Followed by Bank of Hindustan in Kolkata. Established in 1770 by an agency house. Okay. Like we can say, first bank of joint stock variety in India was opened, Bank of Bombay. In 1720, it was in Bombay. And later on, the another bank that got established, that was the Bank of Hindustan. It got established in Kolkata in 1770 by an agency house. Then the General Bank of Bengal and Bihar. This came into existence in 1773 after a proposal by the governor, or we could say the later Governor General, Warren Hastings. Like we could say, actually, first he was the governor of the Bengal. Later on, with the passage of Regulating Act in the same year of 1773, the new position was created, that was the Governor General of Bengal, and Warren Hastings was the first one who became, okay, proved to be a short-lived experiment, which means the General Bank of Bengal and Bihar that came into the existence in 1773, but that could not succeed and eventually closed down. So that's why it is proved to be a short-lived experiment. The first presidency bank. So the first, like we know, the Britishers having the presidencies all over India. They have the three presidency: Bengal presidency, Bombay presidency, and Madras presidency. So in these presidencies, they opened the three different banks. And the first presidency bank was the Bank of Bengal. This Bank of Bengal got established in Kolkata on June 2, 1806 with a capital of rupees 50 lakh. That was the paid up or initial capital that invested in the bank, and then the bank got established. The bank was given powers to issue notes in 1823. Got it? Like we could say, in priorly it was established as a deposit and lender. Later on, it also got a power to issue the notes under the mandate of British Indian government. Then we have Bank of Bombay. Bank of Bombay was actually the second presidency bank. Got set up in 1840 with a capital of rupees 52 lakhs. Got it? It was second after the Bank of Bengal, and the capital was raised by 2 lakhs. Like previously, the Bank of Bengal had the capital of 50 lakhs. Bank of Bombay now had the capital of 52 lakhs. And the third was Bank of Madras. It was the last presidency bank, established in July 1843 and had the capital of rupees 30 lakhs. Got it? Then with the collapse of the Bank of Bombay, and the new Bank of Bombay was established in January 1868. Got it? Then the Presidency Bank Act. It came into existence in 1876, brought the three presidency banks under the common statute and imposed some restrictions on their business. Like we can say, all the three presidencies bank established on different times. Okay, established on different regions and having the different statute and restrictions. But they all were supposed to be work together. So that's why basically in 1876 the Presidency Bank Act came into the power, and that Bank Act put all the presidencies bank, which were three in numbers, under the common statute and imposed some restrictions on their business. Now we have the first Indian owned bank. That was the Allahabad Bank. Got set up in Allahabad in 1865. Okay. The second was Punjab National Bank, PNB also. It was set up in 1895 in Lahore. Later on, its headquarters shifted to the Amritsar and then Delhi. And the third, that was the Bank of India, set up in 1906 in Mumbai. And all these banks were founded under the private ownership. Like we can say, the Presidency's Bank and other banks were established by the Europeans and generally having the government ownership. But all these banks that we had discussed right now, these banks were the first bank that were having the private ownership. After this, Swadeshi movement of 1906 provided the great impetus to the joint stock banks of Indian ownership, and many more Indian commercial banks, such as the Central Bank of India, Bank of Baroda, Canara Bank, Indian Bank, and Bank of Mysore, got established in 1906 to 1913. The late Shri Vithal L. Kavetekar, he pioneered the urban cooperative credit movement in year 1889 in then princely state of Baroda. The first registered urban cooperative credit society was the Conjeevaram Urban Cooperative Bank, that organized in Conjeevaram in the Madras Presidency. So these were, you can say, some kind of alternatives to the British system. There is an important note that we could discuss. They were known as the presidencies banks as they were set up in the three presidencies that were units of administrative jurisdiction in the country as per the command of East India Company. Okay. The presidencies banks were governed by the royal charters because they were established by the royal government of East India Company on that time. The presidencies bank issued the currency notes until the enactment of the Paper Currency Act 1861. When this right to issue currency notes by the presidency banks was abolished, and that function was unsuited to the government. So we can say when the banks were established, basically they had the responsibility to print the notes, but the Paper Currency Act 1861 restricted the presidency bank's power to print the notes, and now this has been given to the government. Now, history of banking sector in India. As we had discussed, so these presidencies banks were amalgamated into a single bank, and that was the Imperial Bank of India, in 1929. Okay, I remember that Imperial Bank of India was actually the today's State Bank of India. Like in 1956, when we nationalized the Imperial Bank of India, we changed the name and we named it as a State Bank of India. It also functioned as a central bank prior to the establishment of Reserve Bank of India, which got established in 1934. The Imperial Bank of India performed three sets of functions, with commercial banking, central banking, and banking to the government. By 1930, number of commercial banks increased to 107, with the Imperial Banks of India still dominating the Indian banking sector. The Indian Central Banking Inquiry Committee that got set up in 1929 to survey extensively the problems of Indian banking observed that the central bank be established for the country. And as per this, the Reserve Bank of India in 1924 got enacted, paving the way for setting up the Reserve Bank of India. The issue of bank failures and need for catering to the requirements of agriculture were two main prime reasons for the establishment of Reserve Bank. The banking sector came under the purview of Reserve Bank in 1935 as per the mandate of RBI Act. The government therefore first implemented the exercise of nationalization of the Imperial Bank of India with the objective of extension of banking facilities on a large scale, more particularly in the rural and semi-urban areas for diverse other public purposes. Imperial Bank of India converted into the State Bank of India in 1985, as I've told you, by enacting the State Bank of India Act 1955. Now, if we talk about the different stages of development of Indian banking system, so the Indian banking system starts with the indigenous banking system, which was mainly carried out by the businessmen called Sharofs, Seths, Sahukars, Mahajans, Chetis, etc. Like these were the one who provided the finance to the people. But remember, these were not the one who obtains the deposit from the people. Okay. Modern banking in India originated in the last decades of 18th century. The first banks were the General Bank of India, started in 1786, and the Bank of Hindustan. Thereafter, the three presidencies banks, namely the Bank of Bengal, was originally started in the year 1806 as Bank of Kolkata, and then in the year 1809 became the Bank of Bengal. The Bank of Bombay and the Bank of Madras were set up. These three banks were merged in 1925 to form the Imperial Bank of India. The Allahabad Bank, established in 1865, is the oldest survived joint stock bank in India. The Punjab National Bank, established in Lahore in 1895, it is new one of the largest bank in India. Then a major landmark in the Indian banking history took place in 1934 when decision was taken to establish the Reserve Bank of India, which started functioning in 1935. Since then, the RBI has a central bank of the country and has been regulating the banking system. In 1949, to have the close integration between the policies of Reserve Bank and those of the government, it was decided to nationalize the Reserve Bank immediately after the independence of the country. And to streamline the functioning of commercial banks, the Government of India enacted the Banking Companies Act 1949, later changed as the Banking Regulation Act 1949. The RBI acts as a regulator of bank, banker to the government, and bankers bank. To serve the economy in general and the rural sector in particular, All India Rural Credit Survey Committee recommended the creation of state partner and state-sponsored bank by taking over the Imperial Bank of India and integrated with it. The former state-owned or state-associated banks, as an act, was accordingly passed in Parliament in May 1955, and the State Bank of India was constituted on 1 July 1955. Later, the State Bank of India Subsidiary Banks Act was passed in 1959, enabling the State Bank of India to take over the 8 former state-associated banks as the subsidiaries, later named associated. The Indian banking system witnessed a major revolution in the year 1969 when 14 major commercial banks in the private sector got nationalized on 19 July 1969. Most of these banks have a deposit of about 50 crores. In 1980, another 6 more commercial banks with a deposit of above 200 crores were nationalized. Now we have the regional rural banks. In 1975, a new set of banks called the Regional Rural Banks were set up on the recommendations of working group headed by Sri Narasimhan to serve the rural population in addition to the banking services offered by the cooperative banks and commercial banks in there. New private sector banks. In 1991, Narasimhan Committee recommended that the bank should increase operational efficiency, strengthen the supervisory control over banks, and new players should be allowed to create a competitive environment. Based on the recommendations, the new private banks were allowed to start functioning. Now, major controls introduced in banking sector after 1968 year reform introduced. In 1962, in order to ensure the safety of deposit of all small depositors in the bank, Deposit Insurance Corporation Act 1961 was enacted. As per this, the Deposit Insurance Corporation of India was established in January 1962. In 1963, Agriculture Refinance Corporation was set up by the Act of July 1, 1963. Objective was to refinance central line mortgage banks, state cooperative banks, and scheduled commercial banks. 1965 Credit Authorization Scheme was introduced, under which the commercial banks were required to obtain prior permission of Reserve Bank of India for sanctioning any fresh working capital limits above the prescribed norm, revised from time to time. 1968 National Credit Council set up in Feb 1968 to assist the Reserve Bank of India and government to allocate credit according to plan priorities. 1969 14 banks with deposit of rupees 50 crores was nationalized. 1969 lead bank scheme was introduced to mobilize deposit on a massive scale throughout the country and also for setting up lending to the weaker sections. 1972 concept of priority sector was formalized. Specific targets were set out in November 1974 for public section banks and in November 1978 for private sector banks. In 1972, differential rate of interest scheme was instituted to cater to the needs of weaker sections of the society and for their upliftment. 1980, 6 banks were demand and time liabilities greater than 200 crores as on March 14, 1980, nationalized on 15th April 1980. 1994 Board for Financial Supervision set up within RBI to extend exclusively to supervisory function and provide effective supervision is an integrated manner over the banking system, financial institutions, NBFCs, and other para-banking financial institutions. 1995 Banking Ombudsman Scheme introduced under the provision of BR Act 1949. 206 Banking Codes and Standard Boards of India set up by Reserve Bank of India in order to provide for voluntary registration of banks committing to the provide customer services as per the agreed standard and all. So here we have finished the topic. Now it's a part for summary. So we have seen the definition of banking, like core activities and expanded services, regulatory overview, like RBI status and the recent innovations, market share, public versus private banks, and introduction of mobile wallets. Historical backgrounds in which we have seen the early banks, and then we have seen the early banks which were owned by the Indians. Like formation of RBI, we have seen in which we have seen the Imperial Bank and the RBI establishment. Nationalization, first phase and second phase we have seen. Rural banking initiatives like the establishment of regional rural banks we have seen, and priority sector lending we have seen. Key legislation policies we have seen like Banking Regulation Act 1949, Deposit Insurance Corporation 1962, Narsimhan Committee 1995. Recent developments we have seen like regulatory framework and financial inclusion. Okay. So we can say the Indian banking system evolved from traditional deposit taking and lending to a comprehensive financial service model, concerned primarily by the Reserve Bank of India, undergone significant changes through nationalization, establishment of rural banks, and modern banking practices. Historically, developments include the formation of key banks and the transition to a regulated framework promoting the financial inclusion and stability. Key legislative actions have shaped the current landscape, enhancing the efficiency and accessibility of banking services in India. So students, here we have finished our topic. It is requested to all of you kindly revise the facts and figures that we have discussed in this lecture and be ready for the next lecture. With this note, let's end this lecture and thank you.